Good morning, guys. Moving on to the next chapter, that is chapter number 9, dividend policy. So, in the previous chapter, previous class, we completed capital structure. So, with that capital structure, uh, this dividend policy also goes in the same line, like capital structure. This is also a small topic where you will be learning how a dividend policy will affect the market price of the firm. See, basically, what is dividend? Dividend is a portion of profit which has been distributed to the shareholders. And what is the remaining portion of the profit? It is called retained earnings. See, suppose profit after tax, which is also called from profit after tax. If you deduct the preference dividend, you will get profit available to equity shareholders. So, out of that profit available to equity shareholders, some portion will be paid out as dividend. So, how much should be paid out as dividend? In order to maintain a uh, optimum dividend, like in order to maintain an optimum market dividend policy, or in order to make maximum market price, that is a dividend policy will is a key important decision of a finance manager. Out of three decisions, like for finance manager there are three decisions which is very key important decisions. One is investment decisions, how much should be invested, how much of money is required, so that calculation is called investment decision. Next is financial decision. Financial decision is that amount of investment which has been decided, how it should be procured, that funds, in what way it should be procured, how much should be debt, how much should be equity, that is called financing decision. And the last one is dividend decision, how much should be paid out as dividend and how much should be retained for reinvestment. That decision is called dividend policy. So this dividend decision plays a very important role in as a key decision of finance manager. And very important, this importance of this dividend policy is it determines the that portion of profit which is being distributed and that portion of profit which has been pulled back as reinvestment. So that is the importance of this dividend policy. And the main objective of financial management is to improve, like for any company, that financial management, what they will do, they want to they want to maximize the market value of the share. So this dividend policy is one key area in order to increase the market value of share. Okay, see, market value of share, suppose it is 50 rupees, then by either paying dividend or retaining the profits, you can increase the market value share. So this is very important policy, dividend policy. So determinants of dividend policy, these are the different determinants. You will just go through it when you are going through the sum, just go through it as theory. So with that, in dividend policy, there are four ways of calculate, like four models actually. What are those models? Is traditional model, which is also called as Graham and Dood model, Walter model, model, and one more thing is Gordon model. So Gordon model, model, traditional model, and Walter model. All four are different models under which a dividend policy is determined. So we'll just go through each model when we are going through the sum for that particular model. So going through this separately as theory, you won't understand the concept. Whereas if you go with an example, that is a problematics, then you will understand the concepts. So with that, we'll move on to, so simple. You have you have understand like dividend. What is dividend? Dividend is a portion of profit which has been distributed to the shareholders. That is point number one. Second, the remaining profit which is not distributed is called retained earnings. That is point number two. Point number three, this dividend decision plays a key important role for maximizing the market value of the firm. That is market price of the share. So that is the point number three. So these are the very important 3 points which you will find it important when you are solving the problems. So okay, with that, moving on to problem number 4. First we are going through the Gordon model. First, see what they have given. Mr. A is contemplating purchase of 1000 equity shares of a company. Okay, his expectation of return is 10%. See, if I am Mr. A, I am planning to purchase 1000 equity shares of a particular company. and my expectation as return is 10% before tax by way of dividend. See, I'm expecting 10% before tax by way of dividend with annual growth of 5%. That is what I'm expecting from that purchase of 1000 shares of equity company is 10% before tax, 10% return on return of 10% before tax with annual growth of 5%. So the company's last dividend was 2 per share. So last dividend which a company paid is 2 per share and growth is 5%. Even as he is contemplating, Mr. A suddenly finds due to a budget announcement, dividend has been exempted from tax in the hands of recipients. But the imposition of dividend distribution tax on the company is likely to lead to fall the dividend of 20 paisa per share. A's marginal tax rate is 30%. Simple. What they have given is due to sudden budget announcement. Normally, see, first will come from the beginning itself. I am Mr. A. I am planning to purchase 1000 equity shares, and my expectation is 10% before tax by way of dividend, and with the annual growth of 5%. So my dividend expectation is 10%, and my annual growth is 5%. The company's last paid dividend is 2 per share. You understood that till that. Next is, even as he is contemplating, Mr. A, I suddenly found that due to some budget announcement, dividend has been exempted in the hands of recipients. So I am the recipient here. I am purchasing the share. I am receiving the dividend. So I am the recipient of dividend here. So dividend is exempted in the hands of recipients. But imposition of dividend distribution. But taxing, instead of taxing that dividend in my hands, it is be taxable in the hands of company as dividend distribution tax. So because of this dividend distribution tax on the company, that it is likely to fall in dividend of 20 paise per share. So for per share, they distributed 2 rupee previous year. From that, 20 paise per share is to be fallen down because of this dividend distribution tax. And A's marginal tax rate is 30%. So I am I am falling under the tax rate of 30%. So calculate what should be the Mr. A's estimated price per share before and after budget announcement. So here they didn't announce, they didn't give in what model you should find, or they didn't tell what you want to find. They just asked you estimate the market price per share before and after the budget announcement. So before the budget announcement, 2 rupee per share dividend, growth at the rate of 5%, return at the rate of 10%. So with that we can easily find. So after budget announcement, 2 minus 20 paisa will get 1.8, 5% growth rate, 10% return. With that we can easily find what is after budget announcement market price per share. So first we'll go through what is Gordon model, and then we'll come off to answer. So see, page number 179. Gordon model has also proposed a model suggesting that dividend policy is relevant and can affect the value of share that of the firm. Simple. This Gordon model, it is having a relationship between dividend policy and the market value of share. So based on the dividend policy, it affects the market value of the share and that of the firm. So suppose a dividend policy is 30% payout dividend and 70% retained earnings. So that will affect the market value of the share. That is what explained in the Gordon model. And this model is also based on similar assumptions that of Walter. So Gordon and Walter are same. So how this dividend policy has been under Gordon model is being calculated. That is market price per share using the Gordon model has been calculated. Point number 1, the growth rate of the firm is a product of retention ratio and the rate of return. This one we have studied in cost of capital itself. What is the G formula, growth rate formula? Growth rate is equal to retention ratio, that is 1 minus dividend payout ratio into rate of return of the expected on that particular reinvestment. So retention ratio into rate of return. Below that, cost of capital besides being constant is more than the growth rate. That is always this cost of capital will be more than the growth rate. So this is what two assumptions in this Gordon's model. And Gordon argues that investor does have a preference for current dividends, and there is direct relationship between dividend policy and the market value of the share. Only one thing in this Gordon model you should remember, that is there is a direct relationship and there is a relationship between dividend policy and the market value of the share. Suppose a dividend policy is being affected, then it will affect the market value of the share. There is a direct relationship. So this model is built upon basic premise of that the investor are basically risk averse. Risk averse is nothing but they don't want to take risk, whereas and they evaluate the future dividends or capital gains as a risky and uncertain question. See, under this Gordon model, the investor are basically risk averse. That is, it is assumed that the investor are basically risk averse. So investors are basically risk averse. So they evaluate this future dividend and capital gains as risky and uncertain proportion. That is, this future dividends and capital gains are always risky. That is what the assumption of this investors under this Gordon model. So what is the, how you will find the market price per share? P is the price per share is equal to earnings into 1 minus retention ratio, which is nothing but dividend payout ratio. So D, E into 1 minus B is nothing but dividend. So dividend divided by cost of equity minus retention ratio, that is growth rate. Retention ratio into rate of return. So in simple terms, dividend divided by cost of equity minus growth rate. If you calculate this, you will get what is the market price per share. If you are using future dividend, then D1 divided by KE minus G. For current price, D divided by KE minus G. So as simple as that. This Gordon model is nothing but market price per share is equal to dividend divided by cost of equity minus growth. That's all. That is what you should find in this Gordon model in order to find the market price per share. So moving on to the problem number 4. First calculation. First, they have asked us to calculate what is the price per share, market price per share before and after budget announcement. So before budget announcement, it is very simple. KE price per share is equal to dividend divided by cost of equity minus growth rate. That is the before share. And future D1 divided by KE minus G. That is the future price of the company. So with that, we'll move on to the problem. Take the notes. They've asked us to calculate before and after budget market price per share using the Gordon's model formula. Gordon model, market price per share is equal to dividend divided by KE minus growth rate. Okay. Put the heading chapter number 9, dividend policy. Chapter number 9, dividend policy. And also put the topic Gordon model. Gordon model, underline it. Below that, problem number 4. Below that, problem number 4 and statement number 1. Statement number 1. Calculation of value per share before decision of finance manager. Before announcement of statement number 1, calculation of value per share. Calculation of value per share before budget announcement of before budget announcement. Done. Calculation of value per share before budget announcement. Below that, small Roman number 1. So what is the expected dividend before a budget announcement? See, budget announcement, last paid dividend is 2 rupees and growth rate is 5%. So growth rate is 5%. One second. One second. So sorry. This is problem number 5. This is problem number 5. One second. Sorry. Take down. Just erase that heading alone. Continue. Problem number 4. Calculation of value per share before budget announcement. Calculation of value per share before budget announcement. They have asked us to find 2 things. That is, one is what is the price per share before budget announcement, and second one is after budget announcement. So under that before budget announcement, record PO. PO means market price per share before budget. That is at the beginning of the year. PO is equal to PO is the price per share, current market price per share. PO is equal to, before budget announcement, how much is the dividend? 2 rupee per share. So first take down the formula. PO is equal to D1 divided by KE minus G. D1 is nothing but dividend, KE is nothing but cost of equity, G is nothing but growth. So is equal to, what is D1 here? 2 rupee per share. So 2 divided by cost of equity. So see, as a recipient, as a equity shareholder, whatever I am expecting as return is the cost to the company. See, if suppose I hold 1000 shares in a company, I am expecting 10% return on investment, and company is paying 10% return on investment. For me, that 10% is the ROI, that is return on investment for investing in that 1000 shares. From the company perspective, that 10% is nothing but cost of equity. For that equity, they are paying that amount as dividend. So for me, that is return on investment as dividend. For the company, that is cost of equity, that is paid out as dividend. So 2 divided by, what is the cost of equity in this particular case? 10%, because my return on investment expected is 10%. So cost of capital for the company is, cost of equity for the company is 10%. So 2 divided by 0.10 minus, what is the growth rate given here? Directly they have given 5%. So 0.5. 0.1 divided by 0.1 minus 0.05. So 2 divided by 0.1 minus 0.05 is equal to 2 divided by 0.05. 2 divided by 0.05. So you are getting is equal to rupees 40. So before budget announcement, PO is equal to 40, which is nothing but market price per share is 40. Now below that, calculation of value per share after budget announcement. Calculation of value per share after budget announcement. So after budget announcement, how much is the dividend? Same formula you should use. 2 minus 0.2, you'll get 1.8. From that 1.8 divided by expected cost of equity. That is, cost of equity is 0.1 and growth rate is 0.05. So if you calculate that, you will get what is the value per share after budget announcement. So below that, PO is equal to D1 divided by KE minus G. D1 divided by KE minus G. So what is the expected dividend after budget announcement? Is equal to 2 minus, within bracket record, 2 minus 0.2 divided by 0.10 minus 0.05. 2 minus 0.22 is nothing but dividend which has been paid out, minus what is the reduction in dividend? 0.2, that is 20 paisa. So 2 minus 0.2 divided by cost of equity is 0.10, cost growth rate is 0.05. So 0.10 minus 0.05 is equal to, below that is equal to 1.8 divided by 0.05. 1.8 divided by 0.05 is equal to rupees 36. Rupees 36, that is market price per share after budget announcement is 36 rupees. Now moving on to problem number 4. So that is problem number 4 is over. Just mark it, tick it around that. Just tick here. Problem number 4 is over. Now moving on to problem number 5. Same Gordon model. So a company pays dividend of rupees 2 per share with a growth rate of 7%. Okay, a company pays a dividend of 2 per share. So it is paying dividend of 2 per share with a growth rate of 7%. So growth rate of the company, that is retention ratio into rate of return is 7%. The risk-free rate is 9% and the market return is 13%. So we can easily find what is the risk-free rate plus using the CAPM model, that is capital asset pricing model. We can easily find what is the return on equity using the risk-free return, market price and the company's beta. So what is the formula for CAPM model to calculate the cost of equity? RF plus beta of the stock into RM minus RF. If you use that formula, you can easily find what is return of equity. However, due to the decision of finance manager, beta is likely to increase to 1.75. Find out the present as well as the likely value of the share after the decision. So they are asking both what is the present market value per share and also the future market value per share. So before decision and after decision. So now using the same Jordan's model, we can easily find. Here they have given what is the dividend and what is the growth rate. So dividend divided by cost of equity minus growth rate, you will easily get what is the market price per share. So put the heading problem number 5. Below that put the heading problem number 5. Statement number 1. Statement number 1. Calculation of value per share before decision of finance manager. Calculation of value per share. Calculation of value per share before decision of finance manager. Before decision of finance manager. So before decision of finance manager, how much is the value per share? Below that point number 1. Below that point number 1. D1 is equal to DO within bracket 1 plus G. DO into within bracket 1 plus G. DO within bracket 1 plus G is equal to, how much is the DO dividend paid last year? 2% with a growth rate of 7% they are telling. So 2 into within bracket 1 plus 0.7. 1 plus 0.07. 2 into 1 plus 0.07, which is 2 into 1.07 is equal to 2.14. 2.14. So that is the dividend expected. So inclusive of the growth, the dividend expected is 2.14. So below that point number 2, below that small Roman number 2, we should find what is cost of equity. KE is equal to RF plus beta of the stock into RM minus RF. That is the CAPM model of finding the cost of equity. So take down KE is equal to RF plus, RF means risk-free rate of return, RF plus B into B, which is nothing but beta of the stock into within bracket RM minus RF. RM minus RF. Below that, take down one by one values. What is RF given in the problem? Risk-free rate is 9%. So is equal to 9 plus what is the beta of the stock before decision? Before decision it is 1.5. So 9 plus 1.5 within bracket market return is 13%, risk-free rate is 9%. So 13 minus 9. 9 plus 1.5 within bracket 1.5 into within bracket 13 minus 9, close the bracket. So you are getting 9 plus, what is 13 minus 9? You are getting 9 into 1.5. You are getting 6. 13 minus 9 is nothing but 13 minus 9 is equal to 4 into 1.5. You are getting 6 plus 9, that is 15%, is equal to 9 plus 6 is equal to 9 plus 6, which is equal to 15%. So cost of equity is 15% if beta of the stock is 1.5. This formula is very, very, very important. Just remember, risk-free rate plus beta of the stock into RM minus RF. RM is risk from the market. That is market rate of return. RF is risk-free rate of return. If you deduct both, you will get that premium. So premium into beta of the stock, you will get premium into beta of the stock plus risk-free rate of return. You will get what is cost of equity. So below that, calculate PO, that is price per share. Current market price per share is equal to point number 3. PO is equal to D1 divided by KE minus G. D1 divided by KE minus G, which is equal to 2.14 divided by what is KE? We have found 15%. So 0.15 minus what is growth? 0.07. 0.07. So it is equal to 2.14 divided by 0.08. You are getting 26.75. This is not 0.7. This is 0.07, which is equal to 2.14 divided by 0.08. Is equal to 2.14 divided by 0.08. Below that, PO is equal to, calculated, 2.14 divided by 0.08. You are getting 26.75. So PO is equal to 26.75. In respect of that, draw a box. PO is equal to 26.75. Below that, now before market prices, that is before decision market price is 26.75. Now after decision we should find. So below that second statement, below that statement number 2, calculation of value per share, calculation of value per share after decision by finance manager, after decision by finance manager. So here dividend will remain the same because there is only change in the beta of the stock, that is 1.75. Below that statement number 1, below that small Roman number 1, D1 is equal to D into 1 plus growth rate. D1 is equal to D into 1 plus growth rate, which we found as 2.14. So is equal to 2.14. 2.14. Below that small Roman number 2, cost of equity is equal to, cost of equity is equal to, write down the formula, RF plus beta of the stock, open a bracket, RM minus RF. Cost of equity is equal to RF plus beta of the stock within bracket RM minus RF. RM minus RF. Below that, what is RF? 9%. They have given 9% plus RF is 9 plus beta of the stock, how much they have given for the revised quantity? 1.75. So beta of the stock is 1.75. Now open the bracket. How much is the market return? They have given 13%. 13 minus risk-free rate is 9. So 9 plus 1.75 within bracket 13 minus 9. 9 plus 1.75 into, open a bracket, 13 minus 9. So now calculate it. How much is 13 minus 9? 4 into 1.5, you are getting 6. So below that is equal to 13 minus 9 into 1.75, you are getting 7. Below that 9 plus 7, below that 9 plus 7 is equal to 16%. Is equal to 16%. Below that, point number 3. Now we know what is cost of equity and growth rate is 7% and dividend is 2.14. With that we can calculate what is the after decision market price per share. So PO is equal to D1 divided by KE minus G. D1 divided by KE minus G, which is equal to, how much is D1? 2.14. So 2.14 divided by 0.16 minus 0.07. 0.16 minus 0.07, which is equal to 2.14 divided by 0.08. 2.14 divided by 0.08. Sorry, 2.14 divided by 0.09. 0.16 minus 0.07, which is equal to 0.09. So 2.14 divided by 0.09. How much is 2.14 divided by 0.09? You are getting 23.77. So which is equal to, below that, PO is equal to 23.78. Draw a box around it. PO is equal to 23.78. So we have found what is the market price per share before decision and market price per share after decision, after change in beta of the stock. So with that we have completed problem number 4 and problem number 5. So with that, moving on to problem number 1. Okay, see here Shakti and Saki, the SN Co earns 6 per share having a capitalization rate of 10%. See, Saki and Co is earning 6 per share, earns 6 rupees per share having capitalization rate of 10% and has a return on investment at the rate of 20%. Once again, so here in this problem they have given what is capitalization rate 10%, which is nothing but cost of equity. So capitalization rate is nothing but cost of equity and return on investment is nothing but ROI, that is return for that equity. So return is 20%, cost of equity is 10%. So and the total EPS, that is per share what they are earning, EPS is 6 rupees. So EPS is nothing but earnings per share. So they are earning 6 rupees at a capitalization of 10% and return on investment of 20%. According to Walter's model, what should be the price per share at 30% dividend payout ratio? So dividend payout ratio is 30%, means retention ratio is 70%. So here 6 rupees is the earnings per share. Into 30% you will get what is the dividend payout. So you are paying dividend at 30% per share. So 6 rupees you are earning per share, into 30% if you do, you can get what is the dividend paid per share. So on the dividend paid per share, if you divide cost of equity minus growth rate, you will get what is market price per share under Gordon's model. Whereas, see, according to Walter's model, what should be the price per share at 30% dividend payout ratio? So here they didn't ask under Gordon's model, they have asked under Walter's model. So you should know what is Walter's model first. And above that, is this optimum payout ratio as per Walter? So you have under Walter, there are some key notes, that is whether dividend should be paid out or not. So you should comment on that, whether it is optimum payout ratio, whether this 30% payout ratio is optimum or not. So for that, first you should know what is Walter model. So moving on to Walter model, come to page number 178. Walter model, very simple. Under Walter model, the formula for calculating the market price per share is dividend divided by cost of equity plus return on equity divided by cost of equity into earnings minus dividend, which is nothing but return divided by cost of equity into whatever the retention. Earnings minus dividend is retention, how much amount it has been retained. Suppose earnings per share is 10 rupees, dividend paid is 30%, means 10 minus 3, remaining 7 rupees is the retained earnings. So 7 into return on equity, ROI divided by cost of equity, whole divided by again cost of equity. Okay, very simple. Return on equity divided by cost of equity into earnings minus dividend divided by cost of equity. That is one part. That is, this part is for calculating what is the future value of the retained earnings, and this part is to calculate the dividend divided by cost of equities, to calculate the market value of the share based on the dividend. So this particular D divided by KE, that is dividend divided by cost of equity, it will calculate the present value of the infinite stream of dividends, and this part it will calculate the present value of the infinite value of the retained earnings. So basically this formula is nothing but dividend divided by cost of equity plus return on equity divided by cost of equity into earnings minus dividend whole divided by cost of equity. You should just remember this formula if you are doing under Walter's model. So under Walter's model, first you should calculate what is P. So market price per share you should calculate, and then the next thing which you should see is a firm can maximize the market value of its share and the value of the firm by adopting dividend policy. See, they ask no in the question, what is the optimum, whether it is optimum or not. So you can assume whether it is optimum or not. You can find it using this particular concept, that is, if return on investment is greater than cost of equity, then payout ratio should be 0. Understand it properly. See, return on equity means from taking the amount, taking the funds from the equity shareholders and investing in the business, you are taking return on investment of certain percentage. So by doing business, you are taking return on such equity. So that return on equity, if it is greater than cost of equity, that is, for procuring that funds, how much you are paying as cost for that particular equity shareholders. If this return on equity is greater than cost of equity, then payout ratio should be 0. That is, your dividend should be 0, so that entire amount of earnings will be reinvested in business and you can make more amount of profits. That is, see, suppose your return on investment is 20%. Okay, by doing a business, your return on investment is 20%, and for procuring cost of equity, that is for procuring equity funds, your cost is 10%. So for procuring 1 lakh rupees, your cost which is being expended, that is cost of equity for 1 lakh rupees is 10%, and by using that 1 lakh rupees and investing in business, your return from that investment, your return from that equity investment is 20%. So 20% minus 10%, remaining 10% is the profit. So whenever your return on investment is more than cost of equity, return on equity is more than cost of equity, the dividend payout ratio should be 0. That is, no rupee, that is 0 rupees should be paid out as dividend. Entire amount, suppose your dividend payout ratio is sorry, your earnings per share is 10 rupees, then the dividend payout ratio should be 0 and retention share ratio should be 100, so that entire 10 rupees again you can invest in your business. From that you can pay 10% as cost of equity and 20% you can take return. 20 minus 10, remaining 10% is the profits. So whenever return, that is return on equity, is greater than cost of equity, dividend payout ratio should be 0. On the contrary, if suppose return on equity is less than cost of equity, that is, if return on equity is 5%, that is, suppose 1 lakh rupees you are taking from cost of equity, that is 1 lakh rupees you are taking from the equity shareholders and you are investing in the business. For that, procuring that 1 lakh rupees, you are paying cost of equity of rupees of 10%, whereas when you invest in business you are getting only 5%. So what you should do, that 10% cost is greater than 5% of return, so you are having negative returns, so return is lower than the cost. So at that point of time, entire amount which is being earned should not be used for the retention purpose, it should be paid out as dividend. Suppose 10 rupees you earned as dividend, if you reinvest in business, that 10 rupees you are going to pay cost at cost of equity of 10%, whereas by investing in business you are taking only 5% return, so you are making a loss of 5%. So entire amount, that is entire earnings should be distributed as dividend. So whenever cost of equity is greater than return on equity, the payout ratio should be 100% and firm should not retain any profits. And when return on equity and the cost of equity are same, it is irrelevant, that is it is up to the finance manager to decide how much percentage of return should be distributed as dividend. Okay, with that we have completed what is Walter model. Simple. If rate of return on equity is greater than cost of equity, nothing should be paid out as dividend. Payout ratio should be 0. On the other hand, if cost of equity is greater than return on equity, then entire amount should be paid out as dividend. That is, entire earnings should be paid out as dividend, 100% dividend payout ratio. And if return on equity and the cost of equity are same, then this dividend is irrelevant. The dividend policy is not expected to affect the market value of the firm. So you can evaluate the market price of the firm by under this Walter model by calculating dividend divided by equity plus return on equity divided by cost of equity into earnings minus dividend whole divided by cost of equity. So with that we have completed this Walter model. See, there is no much difference between Gordon model and the Walter model. Under Gordon's model, like you are going with the growth rate, whereas under Walter's model, you are calculating the difference between return and the cost of equity. So that is the only difference. So under problem number 1, that is problem number 1, earnings per share is 6, cost of equity is 10, and return on equity is 20. So here cost of equity is 10 and return on equity is 20%. So return on equity is more than cost of equity. So it is definitely when return on equity is more than cost of equity, 0% dividend payout ratio is the optimum. So you should not pay out any earnings as dividend. Entire amount should be retained. So according to the Walters model, what should be the price per share at 30% dividend payout ratio? That is point number 1. You can use that formula, that is P is equal to dividend D divided by KE plus R divided by KE into earnings minus dividend whole divided by KE. So using that formula, you can easily find what is the market price per share and is this optimum payout ratio as per Walter. As per Walter, 0% dividend payout ratio is the optimum ratio and 30% is not the optimum ratio. So now take down, coming to the notes, take down problem number 1. Problem number 1. Calculation of value per share. Calculation of value per share at 30% dividend payout ratio. They have asked us under Walter model, calculate the value per share at 30% dividend payout ratio. So calculation of value per share at 30% DP, that is dividend payout ratio. Below that, PO is equal to D1 divided by KE D1 divided by KE plus R divided by KE into E minus D whole divided by KE. R divided by KE, which is nothing but return on investment divided by cost of equity. R divided by KE into E minus D whole divided by KE. E minus D whole divided by KE, which is equal to, what is the dividend paid out here? Leave 5 lines gap below that, note 1. Leave 5 lines gap below that, note 1. So D is equal to, that is dividend is equal to earnings per share into dividend payout ratio. D is equal to EPS into DP ratio. EPS into DP ratio, which is equal to 6. How much is the EPS here? 6 rupees. Dividend payout ratio is 30%, which is equal to 6 into 30%. 6 into 30% is equal to 1.8. Is equal to 1.8. So that is 1.8 is the dividend, and cost of equity is 10% and return on equity is 20%. With that we can easily find what is the market price per share. So below that formula record, how much is the dividend? 1.8. So 1.8 divided by 1.8 divided by 0.1, 1.8 divided by 0.1 plus 0.2, that is return on investment is 20%, return on equity, cost of equity is 10%. So 0.2 divided by 0.1, 0.2 divided by 0.1 within bracket, how much is the total earnings per share? 6 rupees. Dividend payout ratio is 1.8. So dividend payout is 1.8. So 6 minus 1.8. Earnings minus dividend, that is 6 minus 1.8 within bracket, whole divided by 0.1, that is cost of equity. 0.1. So 1.8 divided by 0.1, that is PO, below that PO is equal to 18 plus 1.8 divided by 0.1 is nothing but 18 plus, so calculate this. 6 minus 1.8 is equal to 4.2. 4.2 into 0.2 divided by 0.1, you are getting 8.4 divided by 0.1, you are getting 84. So 18 plus 84, 18 plus 84, which is equal to 102 rupees. So market price per share is 102 rupees. 18 plus 84, which is equal to 102. So below that, in the given situation, below that, point number 2, take down point number 2, that is statement number 2. What they have asked is this optimum payout ratio as per Walter. As per Walter, this is not optimum payout ratio because return on investment is greater than cost of equity. So 0% should be the dividend payout ratio. So below that, take down, in the given situation, return on investment is greater than cost of equity, full stop, is greater than cost of equity, full stop. As per Walter's model, it is advisable to retain, as per Walter's model, it is advisable to retain 100% of profit. When the return on investment is greater than cost of equity, 100% of the profit should be retained. So it is advisable to retain 100% of profit, full stop. Hence optimum dividend payout ratio, in the given situation should be 0%. Therefore 30% dividend payout ratio. Therefore 30% dividend payout ratio is not an optimum dividend policy. Therefore 30% dividend payout ratio is not an optimum policy as per Walter's model. Now below that, record cross check and underline it. Now you are going to cross check the value if the dividend payout ratio is 0. So cross check, underline it. Below that, statement number 3. Calculation of value per share at 0% dividend payout ratio. Calculation of value per share at 0%. See, when return on equity is more than cost of equity, then entire earnings should be reinvested. That is, dividend payout ratio should be 0. So, one second. Okay, sorry guys, I got a call, so I paused the video and I went to talk. So we were discussing about, yeah. So cross check, calculate the value per share at 0% dividend payout ratio. See, here return on investment is 20% and capitalization, cost of equity is 10%. So return on equity is more than cost of equity. So dividend payout ratio should be 0. See, suppose, just think this example. You have earned 6 rupees per share. Earnings per share is 6 rupees. If you are paying 30% dividend payout ratio, you are going to pay 1.8 rupees outside. Instead of paying them 1.8 rupees, if you retain that 1.8 rupees also, you can invest in your business and take a return of 20% on that 1.8 rupees and pay 10% cost of equity on that 1.8 rupees. So you are going to make profit using that 1.8 rupees too. So only when there is return on equity is more than cost of equity, you should always retain all the earnings per share. That is, dividend payout ratio should be 0. So here cost of equity is less than return on equity. That is, return on equity is more. So dividend payout ratio should be 0. That is the answer we have given. But we have to cross check whether the market price per share is more under 0% than 30%. So under 30%, we have found that market price per share is under 30%. We have found that market price per share is 102 rupees. So 102 rupees under 30%. Whereas under 0%, we should find whether it is more than 102 rupees. So calculation of value per share at 0% dividend payout ratio. Below that, PO is equal to, take down the formula of Walters model. PO is equal to D1 divided by KE, D1 by KE plus R divided by KE into E minus D divided by KE, R divided by KE into E minus D divided by KE. So that is the formula for current market price at 0% dividend payout ratio. So here dividend payout ratio is 0. So D1 should be 0. Dividend should be 0. Dividend divided by, that is 0 divided by, how much is the cost of equity? 10%. So 0.1. 0 divided by 0.1 plus numerator within bracket 0.2 divided by 0.1 into 6. So E minus D, what is the value? E is 6. Dividend is 0. So E minus D is 6. So 0.2 divided by 0.1 into 6 whole divided by 0.1. So how much is the value? 6 into 0.2 divided by 0.1. So 12 divided by 0.1, you are getting 120 rupees. So below that, PO is equal to 120. So under 30% dividend payout ratio, PO is 102. Under 0% dividend payout ratio, PO is 120. So market price is greater at 0%. So the cross check is done. So at 0%, there is optimum dividend policy. At 0% optimum dividend policy as per Walters model. So with that, we have completed problem number 1. That we have completed problem number 1. So moving on to problem number 6. Come to problem number 6, again Walter model. So we have already studied what is Walter model. Walter model is nothing but whether dividend payout ratio should be, how much dividend should be paid out and how much should be retained. That is the main concept of Walter's model. So now go read problem number 6. The following figures are collected from the annual reports of ABC Limited. Net profit is 30 lakhs. Outstanding 12% preference shares is 100 lakhs. Number of equity shares is 3 lakhs. So number of equity shares they have given, that is number of shares is 3 lakhs. Return on investment is 20%. So return on investment is 20%. What should be appropriate dividend payout ratio so as to keep share price at 42 rupees by using Walters model? So here we should find what is the cost of equity, that is how much return we are giving for the equity shareholders. That is nothing but cost of equity to the company. So we should find what is cost of equity, and also we should find what is return on investment. We should compare both. If return on investment is more than cost of equity, dividend payout ratio should be 0. And if return on equity is less than cost of equity, then return on investment should be, then dividend payout ratio should be 100%. What should be the appropriate dividend payout ratio so as to keep the market share, that is, so as to keep the share price at 42 by using Walter's model? They have given share price, that is PO is 42. So how much is the dividend payout ratio they are asking? So using that, if you calculate what is the dividend, we can easily find what is dividend payout ratio. So now put that in. For what we should find first, we should find what is the EPS, then we should find how much is the dividend which is paid. So dividend divided by EPS will get dividend payout ratio. They are asking what is the approximate dividend payout ratio. So now come to the notes, put that in. Problem number 6. Problem number 6. Statement number 1. Statement number 1. Calculation of EPS. Calculation of EPS. Using the given data, we can easily find what is earnings per share. What is earnings per share? So below that earnings per share, record two columnar table. First column particulars and second column amount. First column particulars and second column amount. So in respect of particular column, record small a net profit. Small a net profit. Amount column, record 30 lakhs. They have given directly that 30 lakhs. So small a net profit 30 lakhs. From the net profit, you will detect what is the preference dividend, so that you will get what is profit available to equity shareholders. This net profit is nothing but PAT. Here we are considering this net profit as PAT. So less preference dividend. Below that, within bracket, 100 lakhs into 12%. Below that, open a bracket, 1 crore into 12%. 1 crore into 12%, close the bracket. In respect of amount column, record 12 lakhs in bracket. Amount column, record 12 lakhs in bracket. Now amount column, total it. 30 lakhs minus 12 lakhs. You are getting 18 lakhs. Underline it. Amount column, record 18 lakhs. In respect of that 18 lakhs, record small c, profit available to equity shareholders. Profit available to equity shareholders. So below that, small d, that is the total profits available to equity shareholder. If you divide it by number of equity shares, you will get what is earnings per share. So small d, number of equity shares outstanding. Number of equity shares outstanding. Amount column, record 3 lakh shares. Amount column, record 3 lakh shares. Now divide it. Below that, small e, EPS. Small e, EPS within bracket C by D. Total profits available to equity shareholders divided by number of equity shares. You will get what is earnings per share, C by D. So divide it. 18 lakhs divided by 3 lakhs. Amount column, record 6. Amount column, record 6. So that is the earnings per share. Out of this, how much is paid out as dividend? That is, what they are asking in the question itself. Approximately what should be the dividend payout ratio to keep the share price at 42 by using Walter model. So we should first take down the Walter model. In that Walter model, we should put the answer, that is PO is equal to 42. So by using the left hand side 42, that is PO, we should calculate what is dividend. So based on the dividend, we should calculate what is the dividend payout ratio. So below that, small Roman number 2, calculation of dividend payout ratio. Calculation of dividend payout ratio to maintain market price per share. To maintain market price per share at rupees 42. At rupees 42. Below that, first arrow mark. Let's assume dividend payout ratio percentage is equal to X. See, at 42 rupees, what should be the dividend payout ratio? They are asking. So first arrow, let's assume dividend payout percentage is equal to X. So dividend per share is equal to 6 into X. Suppose dividend, we don't know what is the dividend payout ratio. We are assuming it as X. And dividend per share, therefore dividend per share is equal to 6X. 6 into that percentage is the dividend per share, because 6 is the earnings per share. Let's assume dividend payout ratio percentage is equal to X. Below that, therefore dividend per share is equal to 6X. Below that, take down the Walter's model formula. what is the formula? PO is equal to, that is market price per share, PO is equal to D1 divided by KE, D1 divided by KE plus R divided by KE within bracket E minus D whole divided by KE. R divided by KE into R divided by K into within bracket E minus D, that is earnings minus dividend, within bracket earnings minus dividend whole divided by KE, whole divided by KE, which is equal to, below that, what is PO they have given? PO they itself have given 42 rupees. So 42 is equal to, 42 is equal to, what is the dividend which we have calculated? 6x, 6 into x. So 6x divided by, what is the cost of equity? Here the cost of equity, here the cost of equity which they have given is, see, we have to, one second, moving on to the previous statement itself. See, the earnings per share is 6 rupees. Once again, the following figures are collected from the annual report of ABC Limited. Net profit is 30 lakhs, outstanding 12% price is 100 lakhs, number of equity shares is 3 lakhs, non-investment is 20%. What should be the approximate dividend payout ratio so as to keep the share price at 42 by using Walter's model? So we have calculated what is EPS, and we have also calculated what is dividend per share, that is 6x. 6x. So here, yeah, they have missed the number, that is they have missed the cost of equity. They itself should have given that cost of equity is 16%. So in the question itself, record the question, or else here in the material itself, additional point, record it. This will be given in the question, that is cost of equity. Either they will give in the question cost of equity, or they will give this beta and the risk-free rate of return and the market return in order to calculate what is the cost of equity. So here take down cost of equity, KE is 16%. KE is 16%. KE 16%. So now to the formula, come to the formula answer. So just take down the question, KE is 16%. So come to the answer. PO is 42, they itself have given, and dividend is, we have found that it is 6x divided by, in the question 16% is KE. So 0.16 plus, what is the return on investment R? That is 0.2, 20%. So 0.2 divided by 0.16 within bracket, what is the earnings? Earnings per share we have calculated 6. So 6 minus 6x whole divided by 0.16. 6 minus 6x whole divided by 0.16. Whole divided by 0.16. Below that, 42 is equal to, now both the denominators are same. So take common denominator, 0.16. Draw a line below the denominator is 0.16. So 0.2 divided by 0.16. 0.2 divided by 0.16. 1.25 into 6. You are getting 7.5. So 7.5x. Sorry. X plus if you multiply, if you solve this particular equation, you are getting 7.5 minus 7.5x. 7.5 minus 7.5x. Below that, take down 42 is equal to 37.5x. 37.5x plus 7.5 minus 7.5x whole divided by 0.16. So below that 42 is equal to 42. So you are just doing this fraction 0.16 into 37.5x plus 7.5 minus 7.5x. So 42 is equal to 37.5x plus 46.88 minus 46.88x. 46.88x. If you minus 46.88x plus 37.5x, we are getting 9.38x. So 9.38x is equal to, if this 42 comes to the right hand side, it will become negative. So 4.88. Yeah, so which is equal to, x is equal to 52% or 0.52. So 4.88 divided by 9.38, we are getting x is equal to 52%. X is equal to 52%. So below that, required dividend payout ratio as per Walter model is, so this calculation alone, you just do it once again. Like there has been some mistakes here, so that just solve this equation properly, you will get a dividend payout ratio of 52%. So below that, required dividend payout ratio as per Walter model is 52% to maintain the value per share at rupees 42. To maintain the value per share at rupees 42. Here, like if you don't write now that return on cost of equity is 16%, you will find it difficult to understand why this 16.16 came. So in the question itself, just take down cost of equity is 16%, which they have not given in the question, which they should have mentioned, but they didn't mention. But it has been taken in the answer. So with that, we have completed problem number 6. So moving on to next problem, that is problem number 7. The following information pertains to Miss AB Limited. They have given in table, what is that? Earnings of the company is 5 lakhs. Dividend payout ratio is 60%. So total earnings of the company is 5 lakhs and number of shares outstanding is 1 lakh. If you divide that, earnings per share is 5 rupees. Dividend payout ratio is 60%. So out of that, 3 rupees is the dividend payout ratio, 2 rupees is the retention ratio. Sorry, dividend paid out is 3 rupees, retained earnings is 2 rupees. And equity capitalization rate is 12%. Rate of return on investment is 15%. See here, return on investment is 15%, but cost of equity is only 12%. So return on investment is more than cost of equity. So dividend payout ratio should be 0 under Walter's model. So what should be the market value per share as per Walter's model? What is the optimum dividend payout ratio according to Walter's model, and the market value of the company share at that payout ratio? So same thing we should continue. Like same Walter's model method, we should do the problem. So now come to the solution. Take down problem number 7. Problem number 7. Statement number 1. Statement number 1. Calculation of value per share at 60% dividend payout ratio. Calculation of value per share at 60% dividend payout ratio. Below that, take down the formula. PO, which is mean by market price per share. PO is equal to D1 divided by KE plus R divided by KE into KE minus D. R divided by KE into E minus D whole divided by KE. Whole divided by KE. So the formula is D1, dividend divided by cost of equity plus return on investment divided by cost of equity into earnings minus dividend whole divided by cost of equity, which is equal to, what is the dividend payout ratio here? Below that, leave 5 lines gap, leave 4 lines gap, take down note D1 is equal to EPS into dividend payout ratio. EPS into dividend payout ratio, which is equal to, how much is the EPS? 5 lakh divided by 1 lakh. We are getting 5 rupees as EPS. So 5 into dividend payout ratio is 60%. So 5 into 60% is equal to 3 rupees. 5 into 60% is equal to 3 rupees. So D1 is equal to 3 rupees. So we have found D1 is 3 rupees and cost of equity is 12%. So come to the solution, which is equal to 3 divided by 0.12, 3 divided by 0.12 plus within bracket, how much is the return on investment? 15%. So 0.15 divided by 0.12, R divided by K is 0.15 divided by 0.12 into, open a bracket, how much is the earnings per share, that is E5, dividend is 3. So 5 minus 3 within bracket, whole divided by 0.12, whole divided by 0.12. Now calculate it. How much is 3 divided by 0.12? You are getting 25, which is equal to, below that record, 25 plus 25 plus. Now calculate this within bracket, 5 minus 3, that is 2. So 2 into 0.15 divided by 0.12 whole divided by 0.12. You are getting 154. Sorry, you are getting, how much you are getting? 5 minus 3 into 0.15 divided by 0.12. 2.5 divided by 0.12, you are getting 20.83. So 25 plus 20.83, which is equal to 45.83, which is equal to 45.83. With that, we have calculated what is the market value per share as per Walters model. So the second part of the question, that is, what is the optimum dividend payout ratio according to Walters model? How will you calculate the optimum dividend payout ratio? Based on the return on investment and the equity capitalization ratio, that is cost of equity. So here return on investment is 15%, cost of equity is 12%. So return on investment is more than cost of equity. So dividend payout ratio should be 0. So, and the market value of the company share at that payout ratio, that is at 0% payout ratio, what is the market value we should find. So here we have found that optimum dividend payout ratio is 0%. So below that, take down statement number 2. Statement number 2, when return on investment percentage, when ROI percentage is greater than cost of equity, as per Walter, 0% is optimum dividend payout ratio, 0% is optimum dividend payout ratio. So when ROI is greater than cost of equity, then 0% is the optimum dividend payout ratio. So for that 0%, you should calculate what is the market price per share. So below that, in the given situation, return on investment is 15%. Return on investment is 15%, and cost of equity is 12%. Cost of equity is 12%, and so therefore optimum dividend payout ratio should be 0%. Optimum dividend payout ratio should be 0%. So we have found that optimum dividend payout ratio is 0%. Below that, at 0%, what is the market price per share? Under Walters model, we should calculate. Statement number 3. Model number 3. Calculation of value per share at 0 dividend payout ratio. Calculation of value per share at 0 dividend payout ratio. Calculation of value per share at 0 dividend payout ratio. Below that, same Walters model formula. PO is equal to D1 divided by KE plus R divided by KE within bracket E minus D whole divided by KE. This formula and Gordon's formula, all these things write in a paper and just keep revising it, because you should not confuse with the Walters model and the Gordon's model. Walters model will only discuss about the retention ratio and that is return on investment and the cost of equity, whereas Gordon's model won't discuss about this return on equity or cost of equity and all. It will talk about growth rate. So here Walters model formula is D1 divided by KE plus R divided by KE into E minus D whole divided by KE. So that is the formula. D1 divided by KE plus R divided by KE, which means return on investment divided by cost of equity into earnings minus dividend, which is retention amount, that is retained earnings, whole divided by cost of equity. So is equal to, below that, what is the dividend here? 0, because 0% dividend payout ratio. So 0 divided by, what is the cost of equity? 12%. 0 divided by 0.12 plus, what is return on investment? 0.15, and cost of equity 0.12. Earnings minus dividend, that is, what is earnings? 5 minus dividend is 0. So 5 minus 0 is 5. 5 into 0.15 divided by 0.12 whole divided by, what is cost of equity? 0.12. So now calculate it. 0 divided by 0.12, 0, and 0.15 divided by 0.12 into 5 whole divided by 0.12. You are getting 52.083. So below that, PO is equal to 52.08 per share. 52.08 per share. Draw a bracket. Sorry, within box. Show it within box. PO is equal to 52.08. See, under 0% dividend payout ratio, market price per share is 52, and under 60% dividend payout ratio, market price per share is 45. 52 and 45. There is 7 rupees difference because it is not optimum level. 60%. 0% is the optimum level. Next, we have completed problem number 7 with that. So moving on to next, that is problem number 9. Dividend paid. So here, one second. So now moving on to next model, that is problem number 2. Actually, we have seen the older material, that problem number 9, which is not there in this new material because it is older. Some like only the updated questions will be there in this material. So now moving on to next model, that is approach model. We are going to see what is this model. Then we are going to solve this problem number 2. So first we'll read the question, then we'll move on to what is approach, then we'll come to the solution. X Limited had 8 lakh equity shares outstanding at the beginning of the year 2005. The current market price per share is 120. The board of directors of the company is contemplating 6.4 per share as dividend. The rate of the dividend which is to be paid is 6.4, and the rate of capitalization appropriate to the risk class to which the company belongs is 9.6. So cost of equity is 9.6. Dividend paid out is 6.4, and the current market price is 120, and the total shares outstanding is 8 lakhs. So based on the approach, calculate the market price of the share of the company when the dividend is declared and not declared, and how many new shares are to be issued by the company if company decide to fund an investment budget of 3.2 crores by the end of the year, assuming net income for the year is 1.60 crores. Calculate the total market value of the firm after expansion. So we have to calculate all these 3 things using approach. So first we'll see what is approach, then we'll come to this problem number 2 solution. So this approach. So approach basically doesn't take into consideration what is the dividend payout ratio. That is the specific uniqueness of this approach. So first we'll read this. According to this model, the market price of the share does not depend on the dividend payout, whether it is 50% or whether it is 0% or 100% dividend payout ratio. It doesn't affect the market price per share. So under this model, dividend policy is irrelevant. Okay, remember this. Walter model, Gordon model, both will take into consideration what is dividend paid out ratio, whereas under approach, it won't take into consideration what is the dividend payout ratio. So dividend payout ratio is irrelevant. This model explains the irrelevance of the dividend policy. This model explains the irrelevance of the dividend policy. When profits are used to declare dividends, the market price increases. Okay, when profits are used to declare dividend, the market price increases. But at the same time, there is a fall in the reserves for reinvestment. Hence, for expansion, the company raises additional capital by issuing new shares. Simple. When you have profits, suppose you made a profit of 1.5 crores in this current year, you are distributing entire amount as dividends. Suppose it is 100% dividend payout ratio. 1.5 crores entire amount has been distributed as dividend. So for increasing the or expanding the funds, that is for increasing the funds or expanding the business, you need capital. If you have already distributed 100% dividend payout ratio, that is 100% of dividends, then for expansion purpose, you should again issue new shares. If suppose you are not paid any dividend, the dividend payout ratio is 0%, then for expansion, this amount of dividend, that is this amount of earnings which is not being paid as dividend, which is retained as reserves, it can be used for expansion. So increase in overall number of shares will lead to fall in market price per share. Simple. the market value of the firm will remain the same, whereas the increase in number of shares will decrease the market price per share. So hence, the shareholders would be indifferent towards the dividend policy. So whether it is dividend payout ratio or like 100% dividend payout ratio or 0% dividend ratio, the shareholders will be indifferent. That they, it won't affect the shareholders. According to model, the market price of the shares after dividend declared is calculated by using, suppose a company is declaring dividend, then market price per share is equal to future price of the, that is price at the end of the year, market price at the end of the year plus dividend paid at the end of the year, all divided by 1 plus cost of equity is the market price, current market price. Okay, PO is nothing but prevailing market current price is equal to P1. P1 is nothing but market price at the end of year 1 plus D1 is nothing but dividend paid at the end of year 1 divided by 1 plus cost of equity. If you applying this formula, if you find what is the prevailing market price per share before declaring, that is after declaring dividend. So you can compare the prevailing market price per share before declaring dividend and after declaring dividend in order to ascertain whether it is optimum dividend payout ratio, or we can find the market value of the firm using this particular approach. So we have found that formula is for calculating the current market price. Formula for calculating current market price per share is equal to future price at the end of year 1, that is market price at the end of year 1 plus dividend at the end of year 1 all divided by 1 plus cost of equity. So now using that, we have to find what is the market price per share when dividend is declared and not declared, and also how many new shares to be issued by the company if company decide to fund an investment budget of 3.2 crores by end of the year 1, assuming net income for the year will be 1.6 crores. Calculate the market value of the firm after expansion. All three are the three different points which we should calculate. So now come to the notes. First, take down above approach and underline it. Take down approach and underline it. Below that, problem number 2. Statement number 1. Calculation of expected market value per share. Expected market value per share as per approach. Calculation of expected market value per share as per approach. Under two situations you should find out what is under declared and not declared dividend. So first, capital A, below that capital A, when dividend is declared. See, they have already given what is the current market price, that is 120. So what we should find, we should calculate the market price of the share of the company at the end of year 1. So current market price is 120. Using this formula of approach, you can find what is the market price at the end of year 1 by calculating what is the dividend paid at the end of year 1. So below that, PO is equal to P1 plus D1 divided by 1 plus cost of equity. PO means current market price, P1 means market price at the end of year 1, D1 means dividend at the end of year 1, all divided by 1 plus cost of equity. So in respect of PO, what is the current market price? They have given 120. So below that, 120 is equal to, we don't know what is P1, that is market price at the end of year 1 plus. So if dividend is declared, what is the dividend price? Dividend per share 6.4 they have given. The board of directors of the company is contemplating 6.4 per share as dividend. So they are planning to issue 6.4 at the end of year 1 as dividend. So P1 plus 6.4 all divided by 1 plus, what is the cost of equity? 0.096. So now if this 1 plus 0.096 goes to one left hand side, 120 into 1.096, which is 131.52. So P1 plus 6.4 is equal to, below that P1 plus 6.4 is equal to 131.52. Again 131.52 minus 6.4, you are getting what is P1. Below that P1 is equal to 125.12. Underline it, P1 is equal to 125.12. This is when dividend is declared. Suppose when dividend is not declared, then D1 is equal to 0. So below that small b, below that b, when dividend is not declared, below that PO is equal to, same formula, PO is equal to P1 plus D1 divided by 1 plus KE. P1 plus D1 divided by 1 plus KE. See, when dividend is declared, then the board of directors declaring 6.4 dividend, and when dividend is not declared, then dividend D1 should be taken as 0. So below that, PO is equal to P1 plus D1 whole divided by 1 plus KE. Below that, what is PO given? Same 120 market price per share is equal to P1. We don't know what is P1. We should find what is the market price per share at the end of year 1 if dividend is not declared. So P1 plus 0 whole divided by 1 plus 0.916. P1 plus 0 divided by 1 plus 0.916. So if this 1 plus 0.096 goes to that side, P1 is equal to 131.52. Below that, P1 is equal to 131.52. Simple. This dividend is not making any big effects on the market price per share. Suppose if this 6.4 has been distributed, then it will be reduced from the market price per share. Suppose see, dividend is not declared, then market price per share is 131.52. If suppose dividend is declared, then what is the dividend declared? 6.4. Just minus that 6.4 rupees from the market price. The remaining price is the market price per share if dividend is declared. So market price, that is dividend price per share, is not going to affect the market price per share under approach. So it is not having any significant effect. If dividend is declared, the dividend amount will be deducted from the market price at the end of year 1. That is, the dividend amount is the amount which is paid out of the market price. That is, how to understand this is, see, if suppose dividend is not declared, then whatever the profits which have been earned by the company and which has been planned to be distributed as dividend, which has not been distributed, will be added to the market price per share. That's all. So below that, statement number 2. How many new shares are to be issued by the company if company decide to fund an investment budget of 3.2 crores by the end of the year, assuming net income for the year is 1.6 crores? See, net income is 1.6 crores. Then if dividend is paid out, then this 1.6 crores entire amount will go out. So remaining 3.2 crores should be taken as equity shares. Whereas if this 1.6 crores is not distributed as dividend, then out of this 3.2 already 1.6 is there. Remaining 1.6 is only required. So that is how we should calculate how many new shares to be issued by the company. So statement number 2, take down. Statement number 2, calculation of number of shares to be issued. Calculation of number of shares to be issued to fund investment budget. To fund investment budget. Below that, 3 columnar table. To fund investment budget, below that 3 columnar table. First column particulars. Second column if dividend is paid. Third column if dividend is not paid. If dividend is paid and if dividend is not paid. So below that, point number A, small a, amount required for investment. Amount required for investment 320, that is 3.2 crores, which is nothing but 320 lakhs. Everything in lakhs. So amount required for investment in under both the column record 320. Below that, small b, funds from retained earnings. Small b, below that, funds from retained earnings. Below that, current year earnings. Current year earnings. How much is the current year earnings? 1.6 crores, which is nothing but 160 lakhs. So under both the column record 160 lakhs. 160 lakhs. So current year earnings is 160 lakhs. Out of that, if dividend is paid out, there is some amount of dividend which has been deducted from this retained earnings. If dividend is not paid out, this entire amount remains in the retained earnings. So below that, current year earnings record less amount of dividend paid. Amount of dividend paid. Below that amount of dividend paid, just take down. If suppose dividend is paid, how much is the dividend paid? Then the total number of shares is 8 lakh equity shares. And what is the dividend amount? 6.4 per share. So 6.4 into 8 lakhs, that is 51 lakh 20,000, which is nothing but 51.2. 8 lakhs into 6.4 per share. 8 lakhs into 6.4 per share, that is 51.2. So in respect of if dividend is paid, record 51.2 within bracket. In respect of dividend paid column, below that 160 record 51.2 within bracket. So in respect of if dividend not paid, record nil. If dividend is not paid, then amount of dividend paid is nil. So record nil. Now B, total it. Now B, total it. In respect of dividend paid column, 160 minus 51.2, 108.8. 160 minus 51.2, you are getting 108.8. And in respect of if dividend not paid, 160 minus 0, you are getting 160. You are getting 160. So retained earnings. In respect of that 108.8 and 160, record retained earnings. Retained earnings. So see, if suppose if dividend is paid out, the total retained earnings is 108.8. If dividend is not paid, total retained earnings is 160. So if you deduct this A minus B, that is retained earnings. Okay, in respect of retained earnings, record C. In respect of retained earnings, record C, which is nothing but total of B, 160 minus 51.2 and 160 minus 0, that is 108.8 and 160, that is retained earnings. So out of this 320 lakhs, already there is 108.8 lakhs. So if you deduct 320 minus C, that is 320 minus 108, the remaining amount should be procured from equity share capital. So now below that small d, amount to be mobilized by issue of shares. Amount small d, change it to small d, amount to be mobilized by issue of shares within bracket A minus C. Within bracket A minus C. So 320 minus 108.8. How much is there? 320 minus 108.8. You are getting 211.2. In respect of second column, that is if dividend paid, record 211.2. 211.2. And in respect of third column, that is if dividend not paid, 320 minus 160, you are getting 160. So in respect of D, record 211.2 and 160. 160. So what is the issue price per share? Small d. Below that small d, issue price per share. Issue price per share. See, you have clearly found that if dividend is declared, then market price is 125.2. If dividend is not declared, 131.52. So below that, in respect of issue price per share, record if dividend is paid 125.12. 125.12. If dividend is not paid, 131.52. If dividend is not paid, 131.52. That is the issue price. So below that small e, number of equity shares to be held. See, you have to clearly understand why we are taking this issue price per share at the end of year one values, because this investment is going to be if the company decides to fund an investment budget 3.2 crores by the end of the year, so this 3.2 crores they are going to make this fund, that is they are going to procure this fund at the end of the year. So what is the value at the end of the year, that only we should consider. So only this issue price per share we are considering market price at the end of the year. So below that small e, number of equity shares to be held, just divide it 211.20 divided by 125.12. you are getting 1.68798 shares, which is nothing but 1,68,797 shares. 1.68798 shares. In respect of last column, that is dividend not paid, calculate 160 divided by 131.52. you are getting 1.21654. 1.21655 shares. That is 1,21,655 shares. So we have calculated, they have asked us to calculate how many new shares to be issued by the company. So number of equity shares to be issued is 1.68798 shares and 1.21655 shares. With that, we have calculated what is the number of shares required. So last one, what they are asking us to calculate is calculate the market value of the firm after expansion. If suppose dividend is paid, and then we have to calculate what is the market value of shares. And if dividend is not paid, in that situation also we have to calculate what is the market value of shares. So below that, statement number 3, calculate the total market value of the firm. Calculate the total market value of the firm below the three columnar table. Below the three columnar table, first column particulars, second column if dividend paid, and third column if dividend not paid. Particulars if dividend paid and if dividend not paid. Below that, small a, existing number of equity shares. Small a, existing number of equity shares. How much is the existing shares they have given? 8 lakhs. 8 lakh equity shares. In respect of both the columns, record 8 and 8. In respect of both the columns, record 8. Below that, small b. Below that, small b, add new equity shares issued. Small b, add new equity shares issued. How much is the new equity shares issued? We have calculated 1.678 in respect of dividend paid. So in respect of if dividend paid, column record 1.6878, 1.68798, 1.68798, and in respect of if dividend not paid, record 1.21655, 1.21655. Now total it. Existing number of equity shares plus new equity shares will get total number of shares outstanding. Below that, small c, total number of equity shares outstanding. Total number of equity shares outstanding within bracket a plus b. Total number of equity shares outstanding within bracket a plus b. Now total it. 8 plus 1.68798, you are getting 9.68798. In respect of dividend paid, record 9.68798. 9.68798. And in respect of if dividend not paid, record 8 plus 1.21655, that is 9.21655. 9.21655. So that is the total number of shares outstanding. So if you multiply with this total number of shares outstanding with the market price per share at the end of the year, you will get what is the total market value. So below that, small d, expected market value per share at the end of the year. Expected market value per share at the end of the year, that is in respect of dividend paid, record 125.12. 125.12. We have calculated this using approach formula, that is PO is equal to dividend, that is P1 plus D1 divided by 1 plus cost of equity. We will get what is the market value per share under approach. So in respect of dividend paid, record 125.12, and in respect of if dividend not paid, record 131.52. 125.12 and 135.52. The difference is nothing but the dividend amount which has been paid out. Okay, now multiply both the things so that you will get what is the expected market value of the firm. Below that, small e, expected market value of the firm after expansion. Expected, small e, expected market value, expected total market value of the firm after expansion. Below that, within bracket C into D. Within bracket C into D. Now multiply it. 125.12 into 9.68798, you are getting 1212.16. 1212.16. And also multiply the last column, dividend not paid column. 131.52 into 9.21655. You are getting 1212.16. 1212.16. So the expected total market value of the firm after expansion under both the situations are same. So ultimately, this whether dividend paid or not paid, it is not going to affect the market value of the firm. It might affect the market price per share, but it won't affect the market value of the firm in total. So that is the approach. See, in 1 marks, that is in MCQs also they might ask. Under approach, dividend policy, and from that they'll give 4 options. Market value, total market value of the firm will be unchanged. Total market value of the firm will remain constant. They'll give 4 options. Just remember, under approach, whether irrespective of the dividend policy, total market value of the firm will remain the same, and market value per share will not be the same under different options. That is, it will keep changing. And if dividend is paid, market value per share will be low. Whereas if dividend is not paid, market value per share will be high. Whereas they expect the total market value of the firm under approach, that is, irrespective of the dividend, the total market value of the firm will remain the same. So that is the problem number 2. With that, we have studied what is Walter model, Gordon model, and approach model. So next is moving on to problem number 8. Problem number 8. So first we'll read the question. Problem number 8. XYZ Limited has 50,000 outstanding shares. Okay, it is having 50,000 outstanding shares. The current market price per share is 100 rupees each. So PO, that is market price per share, current market price is 100 rupees each. It hopes to make a net income of 5 lakhs at the end of the year. So expected net income at the end of the year is 5 lakhs. The company's board considered a dividend of 5 rupees per share at the end of the current financial year. So D1, that is dividend to be paid at the end of the current financial year, is 5 rupees, and PO is 100. Then the company needs to raise 10 lakh rupees for an approved investment expenditure. The company belongs to risk class, which capitalization rate is 10%. So how does approach affect the value of the firm if dividend is paid or not paid? Same sum as problem number 2 without any changes. We should repeat the same steps so that we will get what is the total value of the firm, which will be the same. Under approach, the total value of the firm under whether dividend paid or not paid, it will remain constant. That is, it will remain the same. So now we know what is total number of outstanding shares, we know what is PO, we know what is D1, and we know what is cost of equity. Using this under approach model, we can find what is P1, that is market price at the end of the year. Okay, put that in. Problem number 8. Problem number 8. Statement number 1. Statement number 1. Calculation of expected market price per share. Calculation of expected market price per share at the end of the year. At the end of the year. Below that, capital A, if dividend is paid, below that PO is equal to P1 plus D1 divided by 1 plus KE. That is the formula for approach. Present market value per share, that is current market price per share, is equal to market price per share at the end of the year plus dividend per share at the end of the year, all divided by 1 plus cost of equity. So below that record, what is the current market price? 100. So 100 is equal to P1. We don't know what is market price per share at the end of the year. That is what we should find. So P1 plus, what is the dividend per share at the end of the year? 5 rupee. So P1 plus 5 divided by 1 plus, then cost of equity is 10%. So 0.1. 1 plus 0.1. So 100 is equal to P1 plus 5 divided by 1 plus 0.1. So 1 plus 0.1, if it 1 plus 0.1 is 1.1. If it goes to the left hand side, 100 into 1.1, you are getting 110. So 110 is equal to P1 plus 5. 110 is equal to P1 plus 5. Therefore, below that, P1 is equal to 110 minus 5, that is equal to 105. So therefore, P1 is equal to 110 minus 5, which is equal to 105. If dividend is paid, then P1 is equal to 105. Below that, capital B. If dividend is not paid, PO is equal to, below that take down the formula, PO is equal to P1 plus D1 divided by 1 plus KE. P1 plus D1 divided by 1 plus KE. So below that, what is the PO? 100. 100 is equal to P1. We don't know what is P1. P1 plus, here if dividend is not paid, how much is the D1? 0. So P1 plus 0 divided by 1 plus 0.1. P1 plus 0 divided by 1 plus 0.1, which is equal to, below that record, P1 is equal to 110. P1 is equal to 110. If dividend is paid, market price per share is at the end of the year is 105. If not paid, 110, which is not, the difference is nothing but 5 rupees dividend. So below that, statement number 2, calculation of number of shares to be issued. Calculation of number of shares to be issued to fund expansion program. To fund expansion program. Below the 3 columnar table. Calculation of number of shares to be issued to fund expansion program. Below that 3 columnar table. First column particulars. Second column if dividend paid. And third column if dividend not paid. See, don't see there and write. It is not clearly visible. Just take down when I am repeating. If dividend paid, third column if dividend not paid. So under particulars record, small a, amount required for investment. Small a, amount required for investment. How much is the total amount which is going to be required for this approved investment expenditure? 10 lakhs. Under both the columns record 10 lakhs. Particulars if dividend paid, if dividend not paid. Under that particular small a, amount required for investment. Amount required for investment under column 2, that is under second column 10 lakh if dividend paid, under third column also 10 lakh. Below that small b, funds from retained earnings. Funds from retained earnings. Small b, funds from retained earnings. Below that small Roman number 1, current year profit. Current year profit. Under both the columns record 5 lakhs. That is 5 lakh rupees it is going to earn at the end of the year. So current year profit is 5 lakhs. Under both the column record 5 lakhs. Below that small Roman number 2, amount utilized for payment of dividend. Small Roman number 2, amount utilized for payment of dividend. Payment of dividend. Record within bracket. How much is the dividend which is going to be paid out? 5 rupees per share. Total number of shares outstanding is 50,000. So 50,000 into 5. Within bracket 50,000 into 5. In respect of dividend paid column, that is second column record 2,50,000 within bracket. If dividend paid column record 2,50,000 within bracket. So last column if dividend is not paid. So in this particular thing we are not considering dividend, that is it is calculated without paying any dividend. So dividend should be nil. So in respect of that utilized for payment of dividend record nil. Record hyphen. So this option is without payment of any dividend. So the amount of utilized for payment of dividend is nil. Now total it. Now B column, that is funds for retained earnings. Small b, total it 5 lakh minus 2,50,000. Underline it 2,50,000. And if dividend, and in respect of if dividend not paid, 5 lakh minus 0, underline it 5 lakh. 5 lakh minus 2,50,000, you are getting 2,50,000, and 5 lakh minus 0, you are getting 5 lakh. In respect of the 2,50,000 and 5 lakh, record retained earnings. Small c, retained earnings. In respect of the 2,50,000 and 5 lakh, record small c, retained earnings. Below that small c, record small d. Small d, amount to be mobilized by issue of new shares. Small d, amount to be mobilized by issue of new shares. Within bracket a minus c. Within bracket a minus c. Small d, amount to be mobilized by issue of new shares. Within bracket a minus c. So what is a here? 10 lakhs. And what is c here? 2,50,000. So in respect of if dividend paid column, 10 lakh minus 2,50,000, you are getting 7,50,000, which is going to be procured from issue of new shares. So in respect of that small d, record 7,50,000. If dividend paid is 7,50,000. And in respect of dividend not paid column, 10 lakhs minus 5 lakhs. 10 lakhs minus 5 lakhs, you are getting 5 lakh rupees. Amount to be mobilized by issue of new shares, you are getting 5 lakh rupees. 5 lakh rupees. So if dividend paid, the amount to be mobilized is 7,50,000. If dividend is not paid, the amount to be mobilized is only 5 lakh rupees. So what is the issue of new price, that is market price per share, that is P1. At the end of the year one only you need this 10 lakh. So at the end of year one, what is the value of market price per share? P1 is 105 if dividend is paid, and P1 is 110 if dividend is not paid. So below that small e, issue price per share. Issue price per share. So total value is 7,50,000. and issue price per share is 105. If you divide both, you will get number of shares to be issued. So issue price per share in respect of second column, that is column number 2, if dividend paid, record 105, and in respect of last column, that is if dividend not paid, record 110. So issue price per share is 105 and 110. 105 and 110. So below that small f, number of shares to be issued. Number of shares to be issued within bracket D by E. Number of shares to be issued within bracket D by E. This issue price per share, remember that we have not given any quote next to that. That is, this issue price per share is nothing but price per share at the end of the year 1. Why we are taking at the end of the year 1? Because this 10 lakh of approved investment fund is required at the end of the year 1. See, the company needs to raise 10 lakh for approved investment for expenditure. The company belongs to the risk class of 10%. Show how does approach. See, always under approach, what are the investment fund they are giving? That investment fund is required at the end of the year 1. So we should calculate what is the market price at the end of the year 1, that is P1 first. Then only we should calculate what is the number of shares which is going to be issued in order to procure that funds. Suppose 10 lakh is required, retained earnings is 5 lakh. If dividend is not paid, that entire profit will be retained. So 5 lakh, remaining 5 lakh should be procured. That 5 lakh will be procured by the issue of new equity shares, but the new equity share price will be priced at the end of year 1. So below that small f, number of equity shares to be issued within bracket D by E. So 7,50,000 divided by 105, we are getting 7143. We are getting 7143. And in respect of dividend not paid column, 5 lakh divided by 110, we are getting 4545. 4546 shares. Round it off, 4546 shares. So that is the total number of shares to be issued, 7143 and 4546. So now they have asked us to calculate how does the approach affect the value of the firm. So we should calculate what is the total value of the firm and what is the effect of this dividend payout ratio to the total value of the firm. So we should calculate what is the total market value of the firm. Below that statement number 3, calculation of market value of the firm at the end of the year. Calculation of market value of the firm at the end of the year. Below the 3 columnar table. First column particulars, second column if dividend paid, and third column if dividend not paid. First column particulars, second column if dividend paid, and third column if dividend not paid. So under 2 situations, we should calculate what is the total market value of the firm. Under situation 1, what is below particulars, record what is the total value of the shares, total number of shares we should calculate, and then we should multiply with the market price per share at the end of the year, so that we'll get what is the total market value of the firm at the end of the year. So below that small a, existing number of equity shares. So what is the existing equity shares they have given? XYZ Limited has 50,000 equity shares. So 50,000. In respect of both the column, record 50,000. Small a, existing number of equity shares. In respect of both the column, record 50,000. And below that small b, add new equity shares issued. Add, underline it, add new equity shares issued. Now take down from the second statement, what is the new equity shares issued? 7143 in respect of dividend paid column, 7143, and in respect of dividend not paid column, 4546. Now total the total number of equity shares. Below that small c, total number of equity shares, within bracket a plus b. Ultimately, we are finding what is the total number of shares which is going to be held at the end of year 1. Multiply with the market price per share at the end of year 1. We will get what is the market value of the firm at the end of year 1. So total number of equity shares within bracket a plus b. So add it. In respect of dividend paid column, 50,000 plus 7143, you are getting 57,143. And in respect of dividend not paid column, 50,000 plus 4546, that is 55,546. So 57,143 and 54,546. 54,540. Below that, small d, expected market value per share at the end of year 1. Expected market value per share at the end of the year 1. Small d, expected market value per share at the end of the year 1. Now under, if dividend is paid, what we calculated P1 105. So in respect of dividend paid column, record 105, and in respect of dividend not paid column, record 110. 105 and 110. Below that, small e, value of the firm. Now multiply both number of shares and the market price per share at the end of the year 1. You will get what is the value of the firm. Now below that, small e, value of the firm. Now multiply it. 57143 into 105. You are getting 6 lakhs, approximately 6 lakh. So in respect of value of the firm, under dividend paid column, record 60 lakhs. 57,143 into 105, you are getting 60 lakhs. And in respect of dividend not paid column, total it 54,546 into 110, you are getting 60 lakhs. So in respect of dividend not paid column, also 60 lakhs. So irrespective of the dividend paid or not paid, your value of the firm is going to remain the same under approach model. That is the concept. Under approach model, irrespective of your dividend policy is irrelevant for the total value of the firm. So whether it is 0%, 10%, 20%, or whether you are declaring or not declaring, that doesn't matter. The value of the firm will remain the same, even if you are distributing or not distributing dividend. So below that comment, as per approach, the market value of the firm will remain the same. The market value of the firm will remain the same. Market value of the firm will remain the same, irrespective of the dividend payments. Irrespective of the dividend payments. So whether you are paying dividend or not paying dividend, the total market value of the firm will remain the same. So with that, we have completed problem number 8. So the last problem number 9. See, problem number 9, it is not about this dividend policy. It is taking into consideration what is P ratio also. So this is an examination problem actually, this problem number 9. We have already solved a problem, we have already solved all the concepts which has been used here. That is, we know what is PE ratio, market price divided by earnings, and we know what is optimum dividend policy. Optimum dividend policy is nothing but if return on investment is more than cost of equity, then dividend policy should be 0%. That is, dividend payout ratio should be 0%. If return on equity is less than cost of equity, then dividend payout ratio should be 100%. That both the concepts we know, we should use both the concepts in this particular problem number 9. Okay, first we'll read the question. The following information are supplied to you. They are given in the tabular column. Particular total earnings is 2 lakhs. So total earnings is 2 lakhs. Number of equity shares is 20,000. So 2 lakhs divided by 20,000, that is 10 rupees per share is the EPS. Dividend paid is 1,50,000. So 1,50,000 divided by 2 lakhs. How much is the dividend payout ratio? Dividend payout ratio is 75%. Then retention ratio is 25%. Then price earnings ratio is 12.5. So if you multiply this price, price earning ratio, what is meant by price earning ratio? Price divided by earnings. What is the return on equity ratio? Earnings divided by price. That is total earnings divided by what is the price at which we are purchasing it. That is, total earnings is nothing but total cost which has been paid to the equity shareholders. So earnings divided by price. At what price the equity shareholders has been procured. So earnings divided by price is nothing but return on equity. So they have given price divided by earnings. So reciprocal of this price divided by earnings is nothing but cost of equity. Can you understand it? Price divided by earnings is nothing but market price per share divided by earnings per share. You are getting 12.5. Whereas, what is the cost of equity formula? Earnings divided by market price. What is the total earnings which has been paid to the equity shareholders divided by what is the market price per share? So if you divide both, you will get what is the cost of equity. So reciprocal of this P ratio is nothing but cost of equity. So that you should understand. PE ratio means market price divided by earnings, and cost of equity is nothing but earnings divided by market price. That's all. That is earnings divided by market price is nothing but cost of equity, and return of equity is calculated by dividing earnings divided by total number of shares. Like total earnings is 2 lakhs, on that divided by total number of equity shares is 20,000. So 2 lakhs 2 lakhs is the total earnings, and total market value is 2 lakhs into 20,000 into 100, 20,000 shares into 100, that is 2 crore. So 2 lakhs divided by 20 lakhs, that is the market value. You are getting 10%, that is return on investment. And cost of return on equity, and cost of equity is reciprocal of price earning ratio. Comparing the earnings with the equity share capital is called return on equity, and comparing the earnings, that is earnings with the market price, is called cost of equity. So here 12.5 is the price earning ratio, reciprocal of it is the cost of equity, and return on equity we can find by 2 lakhs divided by 20 lakhs, that is 10%. So comparing both, we can tell what is dividend payout ratio, whether it should be 0% or 100%. So below that, what they have asked, ascertain whether the company is following the optimum dividend policy. Currently the dividend policy which we found is 75%, whether it is optimum or not, that we should find. Second, find out what should be the PE ratio at which dividend policy will have no effect on the value of share. See, when will dividend policy will have no effect on the value of share? When return on equity is same as cost of equity. Here return on equity is 10%, then cost of equity should also be 10%. If cost of equity is 10%, reciprocal of it is PE ratio. So 1 divided by 10%, that is 10. PE ratio should be 10 in order to have the dividend policy have no effect on the value of share. So next, statement number 3, will your decision change if PE ratio is 8 instead of 12.5? If PE ratio is 8, then what is the cost of equity? 1 divided by 8, which is nothing but 12.5. So cost of equity is 12.5%, return on equity is 10%. Cost of equity is more than return on equity, so dividend payout ratio should be 0%. Sorry, 100%. So we'll solve this sum. We will understand, very easy concept. So take down problem number 9. Problem number 9. Statement number 1. Evaluation of existing dividend policy. What they have asked for the statement number 1, ascertain whether the company is following the optimum dividend policy. Okay, evaluation of existing dividend policy. Below that, small a, we should know what is cost of equity and return on equity in order to tell whether it is optimum dividend policy. First, cost of equity, small a, cost of equity. Cost of equity is nothing but reciprocal of PE ratio. PE ratio formula is price divided by earnings, whereas cost of equity formula is earnings divided by price. So reciprocal of this price earning ratio is nothing but cost of equity. Just remember that this particular formula, remember, cost of equity, formula for cost of equity is what? Earnings EPS divided by market price per share, that is earnings divided by price is the cost of equity formula. So earnings divided by price, which is also called as 1 by PE ratio. Reciprocal of earnings divided by price is price earning ratio. So price earning ratio they have given, so reciprocal of it is cost of equity. So cost of equity is equal to 1 by PE ratio. Record, small a, cost of equity is equal to 1 by PE ratio. 1 by PE ratio is equal to, what is PE ratio? 12.5. So 1 divided by 12.5 into 100. 1 divided by 12.5 into 100. 1 divided by 12.5 into 100, which is equal to 8%. So cost of equity here is 8%. Cost of equity is 8%. Now calculate return on investment. Small b, below that return on investment is equal to, now calculate, how should we calculate return on investment? Either by calculating total value of earnings divided by total value of equity share capital into 100, or EPS divided by market value per share into 100, that is EPS divided by equity share price into 100. So here calculate, return on investment is equal to 2 lakhs divided by, within bracket, 20,000 into 100. Total equity share capital value is 20,000 into 100. 20,000 into 100, that is 20 lakhs, which is equal to 2 lakhs divided by 20 lakhs. 2 lakhs divided by 20 lakhs, which is equal to 10%. So return on investment is 10%. If you are investing 20 lakh rupees, the total earnings which you are going to get is 2 lakh rupees. So by investing 20 lakhs, you are taking back 2 lakhs. You are taking back 2 lakhs. So return on investment is equal to 10%. So cost of equity is 8% and return on investment is 10%. So the optimum dividend payout ratio should be 0% because R is greater than C. That is return on investment is greater than cost of equity. So entire earnings should be retained. So dividend payout ratio should be 0%. Below that, small c, dividend payout ratio. Here they didn't give dividend payout ratio, whereas they were given what is dividend paid. So dividend payout ratio is equal to dividend divided by earnings into 100. Dividend divided by earnings into 100. Dividend divided by earnings into 100. Below that is equal to 150 divided by 2 lakhs into 100. 150 divided by 2 lakhs into 100 is equal to, calculated 150 divided by 2 lakhs into 100, how much you are getting? 75% is equal to 75%. Here when you are using this Walters model and seeing whether how much is the dividend payout ratio, you are getting 0% dividend payout ratio as the optimum dividend payout ratio. That is 8% is the cost of equity. Return on investment is 10%. So return on investment is more than cost of equity. So the dividend payout ratio should be 0%, whereas the company is paying 75% as dividend payout ratio. So it is not at the optimum level. Currently, the dividend payout ratio is not at the optimum level. Below that, take down small d or small Roman number 4. In the given situation, return on investment ROI is greater than KE. Hence, as per Walters model, 0% should be optimum dividend payout ratio. Hence, as per Walters model, 0% should be optimum dividend payout ratio. However, in the given case, the firm is following. The firm is following 75% of dividend payout ratio. 75% of dividend payout ratio. 75% of dividend payout ratio, comma. Therefore, it is not an optimum dividend policy. See, optimum dividend policy should be 0% because return on investment is greater than cost of equity. So instead of 0%, they are following 75%. So 75% is not an optimum dividend policy. So that is the point number 1. Now take down point number 2. Below that, statement number 2, calculation of P ratio at which dividend policy will have no effect on the value of share. Calculation of P ratio at which dividend policy will have no effect on the value of share. Below that, first arrow mark. See, when a dividend policy will have no effect on the value of share, when cost of equity and the return on investment are same, that time the dividend policy will have no effect on the value of share. Below that, first arrow mark, record when ROI, that is return on investment, when return on investment percentage is equal to cost of equity, that is KE, when return on investment percentage is equal to cost of equity, comma, then the dividend policy will have no effect on the value of share. So see, when return on equity and the cost of equity, or when return on investment and the cost of equity are same, irrespective whether you are paying dividend or you are retaining the earnings, this is not going to affect the market value of the share. So when cost of equity and the return on investment is same, it is not going to affect the value of share. Below that, what they have asked, P ratio. So below that, P ratio is equal to 1 by cost of equity. 1 by cost of equity. So here, what is the cost of equity? Cost of equity should be return on investment. Both should be same. Here we have found that return on investment, how much? Here we have found that return on investment is 10%. So return on investment should be equal to cost of equity. So P ratio is equal to 1 by cost of equity. Below that record, P ratio is equal to 1 by 10%. 1 by 10%, which is equal to 10. So P ratio is equal to 10. P ratio is equal to 10. So with that we have completed statement number 2. Below that, statement number 3. Statement number 3. Calculation of optimum dividend policy. Optimum dividend policy if P ratio is 8. Calculation of optimum dividend policy if P ratio is 8. So if P ratio is 8, cost of equity is going to change. So then we have to compare what is cost of equity and the return on investment so that we can find what is the optimum dividend policy. One second. Okay. Will your decision change if P ratio is 8 instead of 5? Okay. See, when P ratio is changing, cost of equity will change because cost of equity is nothing but 1 by P ratio. So we should first calculate what is cost of equity, then compare it with the return on investment of 10%. If it is more than return on investment, then optimum dividend payout ratio should be 0. Okay, now calculate. Below that, first arrow mark, cost of equity is equal to, below the third statement record, first arrow mark, cost of equity is equal to 1 by revised PE ratio. 1 by revised PE ratio. Below that record, 1 by 8 is equal to 1 by 8, which is equal to, how much is 1 by 8? 0.125, that is 12.5%, which is equal to 12.5%, which is equal to 12.5%. So the cost of equity is 12.5%. Below that, second arrow mark, return on investment is equal to 10%. We have found that in the previous statement itself, that is return on investment is 2 lakh divided by 20 lakh, that is 10%. So cost of equity is 12.5%. Return on investment is 10%. So compare this cost of equity and return on investment. Cost of equity is more than return on investment. So what is the optimum payout ratio? When cost of equity is more than return on investment, 100% should be paid out as dividend. So below that, third arrow mark, record. In the given situation, when P ratio is 8, cost of equity is greater than return on investment. Cost of equity, that is KE, is greater than return on investment. Cost of equity is greater than return on investment. Hence, as per Walter's model, 100% should be optimum dividend payout ratio. Hence 100% should be optimum dividend payout ratio. So with that, we have completed problem number 9. Okay, with this we have completed what is we have completed capital structure, cost of capital, and dividend policy, all three. So next we are moving on to capital budgeting. In the next video, we are going to start off what is capital budgeting, and one last chapter where your patience will be tested. There will be sums which will be for 3 or 4 pages. So capital budgeting is very important chapter, easy chapter only, but then you have to remember few formulas where there will be only procedures to follow. Formulas will be the same, but then you have to follow a long procedure. Okay, we'll just move on to capital budgeting in the next video. Okay guys, thank you.